Hi, good morning, everyone. Thank you so much for joining us today. My name is Kathy Delgado. I'll be moderating today's webinar, and we're excited to be hosting Kevin Nill from Haig Partners today, along with Ken Rosenfield and Paul Dumm. I'll go ahead and give the floor to you guys.
Oh, well, say thank you. I'd like to introduce my dear friend, Kevin Nill. I've known a long time and almost every aspect of his career, actually. And we won't say how long that is, but
yeah, thank you.
So, welcome, Kevin. And we're really looking forward to this presentation. So Kevin's going to talk about his insight with Haig Partners on what's going on in the current retail environment for automotive dealers. And then Paul Dumm will finish up with us on some valuation things that we're seeing lately in dealer valuations. And I'm just going to sit and add color commentary today. So I'm all excited about doing that. So Kevin, the floor is all yours.
Perfect. Thank you, Ken. Very much appreciate the opportunity to visit with you and your clients and friends in the industry. Kathy, maybe before I start, you want to give any instructions as it relates to if anybody wants to submit a question? I know a lot of times we do these in person, so it's a lot more interactive, but I think we're a little bit more restricted here. So maybe you want to share how to do that?
Yeah, of course. There is a Q&A feature where you can submit questions, and I'll be monitoring those and making sure that Kevin will answer those. I am also able to give you guys ability to speak. So if you want to have like a, actual speaking conversation with one of us, I can give that access as well. Just make sure you put it in the Q&A. All right, and that's it.
Great.
Awesome.
And any tough questions, make sure you kick them over to Ken and Paul, please. So, well, I know we're short for time. We only have 45 minutes. I appreciate everyone participating and joining. So let's just jump right in. Hopefully, as I transition the slides, you'll see those wherever you're viewing the webinar. Just real quickly, if you're not familiar with Haig Partners, who we are, we represent sellers of higher value dealerships and dealership groups around the country. Advising them, supporting them, whether they're selling their entire enterprise for family reasons or they're selling off a couple of stores for strategic reasons. So this map here is just really to indicate and represent to you that we're coast to coast. We do transactions from Seattle to Miami and LA up to Boston and Maine, et cetera. But and you can see we've got a history of representing some of the largest groups as well as representing just really strong single point operators around the country. So that's a little bit about who we are. Let's just dive right into the market update. What I'm going to share with you are some slides that we've gleaned from the public company releases. Historically, we would supplement this data with information from NADA. Unfortunately, about a year ago, they stopped publishing the synopsis of the dealer performance. And they never really commented on why, but the speculation was because the dealers were doing so well post-COVID that they felt like they did not want that out in the public domain. So what you're going to see here, and I'll give you some clarity as we go through it, but this is an aggregation of the public company data that's released on a quarterly basis. So this first slide is new gross profits per vehicle, and just a little color on how it's calculated. So as you're, as a dealer, you may be looking at your dealer financial statements and seeing gross numbers that are a little bit different. The publics take all that, what we call below the line money, that other income money that's associated with selling the new car, and they put it up into the respective, departmental budget or area line items. So what you're seeing here is gross, not only front end gross, but all that other below the line income. And so overall, you can see we had a tremendous ratchet up in gross profits from a PVR perspective throughout COVID. And then over the last few quarters, we've seen that begin to come back down again. But note that where we stand now through the third quarter of this year is still basically, roughly in line with 2021 and still well over double what we were having historically pre-COVID. I know when we speak to a lot of dealers, they're concerned, they're upset. They're dismayed by the trend, but we try and keep a little perspective in the conversations. While we know it's trending down, I think the general consensus among most dealers and certainly the public companies have communicated this is they believe when gross is settled back down to kind of a normal situation, it should be above historical pre-COVID levels. as manufacturers are doing a better job of matching supply and demand, with some exceptions. So I suspect you're seeing similar results in your portfolio of dealerships as well. And so it's a trend that we're seeing, and we'll talk a little bit more about why. But largely we had such a limited number of units in inventory, which obviously grew gross profits, and now we're starting to see days supply come back to a little bit more of a meaningful level, and so dealers are having to compete a little bit more on the transaction. You can see from a SAR perspective, historically we were in the mid 17s for SAR. We've been tracking, in the mid 15s now for quite some time. It feels like that's kind of a stabilized number. Again, somewhat a function of limited inventory. There are still manufacturers that are struggling. Toyota, Honda, Subaru always has struggled. So there's still a little bit of compression on SAR. We're not seeing significant macro issues that are driving SAR down. Yes, you'll see in a minute interest rates, and we know that has having some impact, but nothing to this, nothing to what we would typically see in a recession where we see 17.5 drop down to 13 or 14 because people are just not wanting to transact. As we talk to dealers, there's still a preponderance of consumers that want to buy cars. So we feel bullish about that. You can see though, this is, we're starting to feel that impact, particularly in those consumers who are payment focused, which are, a significant majority of them, less so in the luxury space and the higher end ticket items. But, as payments have gone up because of rates, it's certainly impacting either the ability for them to transact, period, or, maybe buy a lower priced car or one with less content in it. So, this is definitely something we're seeing consistently. The good news is it seems like the market is reading into the Fed a little bit and anticipating that maybe we've reached the peak from a rate increase perspective, and we'll either stay flat or maybe begin to see some reductions here over the coming quarters.
Hey, Kevin.
Yes.
What do you see in terms of the length of the terms for the notes for vehicles now? Because we're seeing a lot of extended notes going out 72 months, even some more, and
yeah.
the
I think
impact
average
that's
Ken
going to
is
have.
like, average is maybe 75. I mean, even pre-COVID, you were starting to see 84 months begin to become norm. What'll be interesting though is, banks have become, banks and lenders have pulled back a little bit, and just because their credit portfolios are starting to feel some of the weakness. And so whether they dial back those 84-month and 72-month terms, it could be a little bit of a bigger challenge for sure.
We were at clients yesterday, and they were saying people coming in on trade-ins now, and they're super upside down on their cars, and it's getting to be a problem.
Absolutely, because if they bought a car, in 2020 or whatever, I'll show you a slide in a minute here about MSRP, but they were way over MSRP on their car. So now as the used cars have come back down, that there's definitely a negative equity issue that's could rear its ugly head. So to this next slide, you can see, and this is the percentage of vehicles over MSRP year over year. Personally, I'm still surprised by the 29% in October, because as we talk to dealers, it seems like other than niche products, they're really not, seeing a lot of vehicles now over MSRP. They're maybe not all the way down to, back to invoice again, but surprisingly, according to JD Power, still almost 1 out of 3 vehicles is being sold over MSRP, but it is trending down. And I think we're getting back to a little bit more of a normalized perspective in that regard. Used vehicles, we've definitely, come back to a little bit of the, pre-COVID levels. You can see the trend down. We're at about 1,800 PVR. Back in the pre-COVID, we were in the 1,500, 1,600 range. So pretty close to that. Feels like, absent the normal, roller coaster type ride in used cars that we always seem to have. But in general, things are trending back down to, a little bit more of a normal used car environment. And so, unfortunately, we've lost about $700 a copy, but still, hopefully, we'll settle in a little bit north of the historical norms. F&I has always been a strong income provider for dealerships. You can see the upward trend, and for the first time in quite a while, it's kind of plateaued and actually trended down just marginally from a dollar perspective. And what we're hearing consistently is it's not about a less of a focus from dealers on F&I. It's really strictly a function of some consumers are getting, rate shock when they're going in. And if they've got any capacity to be able to pay for cash, they're like, I'm not going to finance my car at 9%. So they'll pay cash. So you're seeing a little bit less interest reserve earned. And then probably the biggest contributor to the decline is because rates are up and because people have a payment they've got to stay inside of, they've got less ability to add products into that payment. And so dealers aren't able to sell either any product or as many products as they used to. So hopefully this is, if we can just flatline around this level for a period of time, and then, as rates come back down, we can, continue to trend back up. I would say that just understand, again, this is public company data. They don't have offshore programs, things like that. So this is just straight F&I and some over remits, programs like that, conventional type numbers. And they all are also skewed a little bit more towards major metros, big stores with luxury. So if you're trying to compare and contrast to your specific dealerships, just keep that in mind so that you're comparing apples and apples. Fixed operations, absent the dip in 2020 when people weren't driving, people weren't acquiring cars, a lot of states were shut down. Other than that, it's just been a nice pickup. Obviously 2021 had a really nice pickup because we had a bit of a lower denominator, but in general, that 10% plus or minus year over year growth just as a consistent earnings driver for dealerships. We're seeing a number of dealerships continue to push labor rates up and have not really seen a lot of pushback from the consumer. So, I would encourage you, if you've been a little reluctant over the past couple of years around your labor rates, maybe revisit that, speak with, Ken and his team and others who are seeing what's going on out there, and they can advise you on that. But in general, we're seeing a strong traffic through the service lanes. People are back driving again, and they're getting better labor rates as well as parts reimbursements. Ken, I don't know if you want to comment on that, because I know you work a lot in the parts reimbursement area.
Yeah, we've seen that. The key is really keeping it on a regular and continuous basis, not go so long. So you have to start fighting with the manufacturers and improving things. So some of the manufacturers are starting to go to a automatic increase level, and they're pretty much staying on par, but just need to reevaluate that. And I wouldn't wait too long to evaluate what your parts reimbursement rate is, and as you go forward all the time. That's something you should take a continuous look at.
So how does this all boil down? What are earnings looking like? So this is the average earnings per dealership of the public companies. And you can see, at one point we were over 3 times what the historical performance was on a per average dealership basis. We're down about 17% year over year. But again, as I mentioned earlier, it's a matter of perspective. So if you look at 5.4 million versus 2 million, we're still up significantly. Obviously, what we're hearing quite regularly from dealers are having to work harder to make the money, having to retrain staff to how to sell, things of that nature. But overall, earnings seem to be still very, very strong, very, very positive. Again, as a caveat, as I just mentioned, typically the publics have major metro stores, so bigger volume, bigger earnings, and luxury brands are more heavily weighted into their portfolio. So when you look at that average of 5.4 and your store's not doing that, just keep that in mind. But overall, hopefully you are seeing the trend that while earnings have receded a little bit, they're still well above historical norms. And as we probably will trend down, that hopefully it will still settle down above the average of 2 million per store.
Kevin, we are seeing really good earnings with our even dealerships not in major metro areas, because typically their overhead's down a little bit and they're still commanding pretty decent gross profits, and they're keeping their overhead pretty low.
Mm-hmm.
So I would say on like a net to sales basis, they're tracking pretty well. Now I know November for a lot of our clients was a little softer than some other months have been, but I think that between a major metro and not major metro, they're holding their own.
Good. That's great. Great to hear. This next slide is really just you know, and I struggle to do this in front of a bunch of CPAs who will, you know, dig into the numbers significantly, but really we're just trying to directionally give you some, what we believe to be some positive information around where the market's going to go. So how this slide works is if you look to the far left, on average, you know, in a normal market, there were about 17.3 million in units being sold, new units being sold every year. And then COVID hits and we have the big pullback. And it was a pullback because there was limited inventory, supply chain issues, you know, everything everybody was acutely familiar with. It wasn't a consumer demand issue. So, you know, in 2020, as you look and see, okay, we sold 14.7 million. So there were about 2.7 million units that weren't sold that year that potentially consumers, and some of it's fleet. We know that, you know, because, you know, this includes fleet purchases, weren't able to acquire. Roll forward, you can see annually what the new car SAR was, and then cumulatively in that red below the line number, what's the cumulative number of units that weren't sold, weren't transacted, even though consumers wanted them. Now, some of them, you know, obviously went into used cars, and again, some of it's fleet. So this is not meant to say, oh, there's 10.5 million cars ready to be sold, you know, now that we've got cars. But directionally, hopefully you agree with the concept that, you know, absent some major macro economic, you know, pullback, there's still a lot of demand out there for vehicles. A lot of consumers either couldn't get the car they wanted, or they were like, I'm not paying over MSRP for a car, so I will just wait, you know, until this thing normalizes a little bit. So yes, we've got a little bit of a headwind with the rate environment that will temper that to a degree. But in general, we believe that over the next few years, we still should have some pretty strong underlying demand for vehicles that, you know, will keep us on a nice steady pace for a period of time. So again, don't hold me to these exact numbers, but hold me to the point that we at least feel directionally there's still, you know, a lot of demand out there for vehicles. We'll shift gears here now, and unless Kathy, there's a question that's come in, we'll shift gears to what's going on in the buy-sell marketplace. Okay. So what you see here is a trend line of the, you know, public and private dealer acquisitions over a number of years. And if you look to the far left, you can see that basically on average, there were about 350 dealerships that trade hands every year. And there's always this feeling that, you know, because the publics are, you know, so well known, and when you open automotive news, there's an article about the public buying somebody, that everybody thinks the publics are the ones that just are driving the buy-sell space. And they're certainly impactful, and they are definitely growing. But you can see the still significant percentage that's in that gray bar, that blue-gray bar, are still privately held dealers who are making strategic acquisitions either in their market or wanting to grow into a new market. You know, and so, you know, that's still very much the primary driver. In 2021, the market exploded. There were obviously some big opportunities in the by the publics. They took down. There were 4 really large transactions that took place that drove that 216 number. But even the privates, you know, added up, you know, almost 500 dealerships. And then in 2022, the publics took a bit of a pause. One, they had to assimilate what they acquired. 2, the market was starting to hit their stock price. There was concern that, you know, maybe we're coming off of our peaks. From a stock market was viewing that the car business was coming off its peaks. And so they hit their stock price a little bit hard. So they really couldn't, from a PE perspective, you know, buy some of these dealerships. But the private companies stepped in a big way. So if you look at what we're experiencing so far this year, we're at 385 rooftops that have changed hands just in the third quarter. So we should trend either, you know, we may not beat last year, but we'll still be well above historical norms. It's a very active market. I'm sure Ken and Paul, you can comment as well. But what's nice about the market is it feels like there's a nice equilibrium, because as many sellers are looking to exit for personal, family reasons, strategic reasons, whatever the case may be, there are equal number of buyers are out there that are wanting to grow. They're looking for scale. They're looking for new markets, and growth markets are looking to add certain franchises that they don't have in their portfolio. So it's a nice balance, and you know, it's become a very it's remained a very strong market. Ken, I don't know if you have any thoughts.
What's also been interesting too in this last couple of years is we've seen a lot more activity in ad points, which has been really fascinating, especially some certain areas. So we've actually done a lot of litigation support work in the last couple of years on ad points and encroachment on markets and things by the manufacturers. So it seems like maybe they're a little bit more aggressive as well and putting in some new points. I don't know if you've seen that, what you're doing as well.
We don't get obviously as involved in ad points as you would. We see them now and then. I think for the most part, it's still some of the selective smaller growing groups like the Hyundais, Kias of the world, Subarus of the world. Every now, you've got a few Toyota and Hondas. You don't see a lot of domestic ad points because in general they're over dealered unless they're going into a growth market. But it's definitely something we pay attention to when we're representing a client because we need to know from a competitive situation what's the growth opportunity for that dealer if another ad point's coming in.
Yeah, the other question I have for you, Kevin, was what are you seeing in first rights or refusals from the manufacturers in a lot of deal?
ROFRs are always a challenge. I would say in general, as a seller, yes, there are some unique situations, but as a seller, even if the OEM ROFRs, that other individual that's stepping into that contract has to honor the contract you've negotiated. So typically you're still realizing what you had negotiated from a net proceeds perspective. But it's definitely become more active with a number of the groups. Mercedes-Benz is clearly very aggressive around ROFRing. The domestics, they come and go. I think some of it's regionally based, how they're wanting to do, and some of the regional managers on what they're wanting to do. Honda has done some ROFRs, so it's something we talk about with each client in each situation. Obviously, the bigger the ticket and the larger the deal, the less likely that it gets ROFR because there are just fewer people that want to step into a contract. But yes, it's something that needs to be thought of and addressed in each buy sell.
We just had a clients yesterday, as a matter of fact, and they were talking about a new point coming in, and they were protesting a new point, and the manufacturer gave a lot of inducement money to the other dealer to help quiet the situation. That was the first time I've seen inducement money in a while as well, at a pretty significant size. So that doesn't impact the buy sell, but it's just been interesting to see what some of the market shifts have been in certain brands.
Yep. Next slide just kind of layers on what we were talking about relative to how much capital at least is being deployed. And you think about it, if the private sector is 4 to 5 times what the public sector is doing, then you can just extrapolate these numbers. So, but you can see like in 2021, those big 4 acquisitions, 200 plus stores, the public's allocated almost $10 billion in capital into the space. So significant investment there. They've begun to do some more international acquisitions. Lithia has bought groups now in Canada. They're buying a group over in Great Britain. Group One and Penske have been overseas for a while. So you're starting to see some more of that as they diversify outside the U.S. But still, the vast majority of their growth is local now. And Ken, you may have seen this as well. Framework issues, tend to come up a little bit with some of the publics, because they have grown with a particular manufacturer beyond their limitations in a region, as an example. So this is another reason why they're trying to look at either other markets or ancillary, indirectly related industries like RV or power sports or marine, things like that. Heavy truck, obviously Penske's big in heavy truck as an example, but overall you can see the publics continue to spend, and they're very vocal, very public, no pun intended, with their communications that they want to continue to grow, and they have big growth targets.
We've seen some framework agreements on non-public companies as well. Some of the larger privately held dealer groups have some framework agreements.
Absolutely. Yep. These big private groups run into the same issue.
Absolutely.
This next slide it's not meant to, thankfully it kills 2 birds. It's not meant to brag as much as it is to just illustrate that while the trends are coming down a little bit from a performance standpoint, great dealerships, great markets, what I would call trophy opportunities for buyers are still transacting at near or record values. The left store I was honored to represent, Al Hendrickson Toyota, was the second largest Toyota dealer in the country down in South Florida. The previous record for Blue Sky for a single franchise, Group 1 bought a Toyota store for $206 million in blue a couple years ago, and this store well exceeded that. Obviously, I can't share specific numbers, but just, you know, great franchise in Toyota. Dealers love Toyota. They love the OEM dealership relationship. They love the brand. They love the support they get. The vehicles obviously resonate with the consumer. Huge market from a volume perspective. So very, very active buyer pool here. And, you know, Larry Morgan, Morgan Automotive, that they acquired that store. The middle store, Lake Norman, CDJRs, 2 CDJR stores up in the Charlotte area. We put that in there. So even though, you know, we talk about Toyota and everybody knows how great Toyota is, these are Stellantis stores, and these stores traded at an all-time record confirmed by Stellantis. So great market, great operator. So it really clicked. And then Crown Toyota over in Southern California, this was a John Elway store for those who are football fans. John Elway, Mitch Pierce owned this dealership, and we sold that to Jeff Swickard, and at the time that was the 3rd highest price ever. So again, yeah, I guess we're patting ourselves on the back, but really the intent here is just to communicate that if you have great assets, great franchises, excellent markets, buyers are still pushing very much forward and are aggressive around, you know, those acquisition opportunities.
Hey, Kevin, before
Yes.
we get off that, can you touch on what you're seeing as the main motivation for the sellers in these and other transactions? And has that changed over the course of time here in the last couple of years?
Absolutely. Thanks, Paul. I would say, so when people sell, there's a core group that it's a family. I don't have succession. I'm tired. It's just that it's that time in my, you know, life personally, as well as from a business perspective, it's time to go ahead and exit. So that's a significant percentage of dealers that are exiting. That's been supplemented over the last few years by a number of dealers who have had very, very strong earnings, as we talked about. They're seeing very high valuations on their stores, and maybe they were thinking of selling 3, 4, 5 years from now, but they pulled ahead that decision because the values are so strong. And it's giving them that flexibility personally and financially to do something else. Maybe they want to retire, but maybe they want to get into other investment opportunities, businesses like that. So you've got dealers like that, you know, in the post-COVID era, and now you've got some dealers that conversely wanted to make those record earnings. Now they're still generating strong earnings, but valuations are high. So they're like, okay, well, you know, I really enjoyed the benefit of 2020, 2021. But now, you know, I still want to go ahead and sell while I can and get good value. I think the other things we hear about consistently from dealers, it's getting harder and harder to compete against the large groups, whether they be private or public. If you're a single point to upwards of 5, 6, 7 stores, scale is becoming more critical for dealers. Less so around expenses. Yes, there are some benefits to having scale from an expense perspective, but in general, you know, some of the big benefits are around your ability to allocate capital and resources for facilities, for the digital technology, for, you know, to have the best staff, to retain them, to allow them to grow. If you've got a wonderful GM in a store, a GSM maybe, and he wants to become a GM, but you only own 1 or 2 stores, he or she feels like they're capped out. But if they go work for somebody who's got 10 or 15 stores, there's a lot of career opportunity. So having scale for you know, human capital is really important. But the biggest thing we've seen is since COVID, people were getting accustomed to the Amazon effect of buying things. We're all used to that. But when COVID hit and their local dealer didn't have the car or vehicle that they wanted, whether it was color, content, trim package, whatever, they got more comfortable in going online and buying that car from a dealer that was maybe 200, 300, 400 miles away and having it shipped to them. And now you're starting to see these big mega groups be able to go online and, you know, publish that they've got 3,000 vehicles to select from versus the local dealer who might have 200. So just that shopping strength of your inventory has been a big benefit. as well. And then just frustration with the manufacturers. They just seems like every day they're more and more in control of the dealer and his or her business. And these are entrepreneurs that want to feel like they can manage their business to their the best of their abilities. And so much of the control is around the OEMs and the below the line programs, and I have to do X, Y, and Z to make any money. So I think I'm probably missing 2 or 3, but those are some of the high level one. Paul, I don't know if you or Ken or seen some other ones.
Has the push for EVs come into their thinking?
It's certainly
It's
certainly a factor, and we've got some slides here in a minute on the EV, but it absolutely, and particularly with some OEMs more than others, say Ford as an example, we've certainly seen some dealers, reconsider whether they want to have that brand anymore, or if that's their only brand, if they want to bet their future wealth on the frustrations of Ford. But in general, I wouldn't say EV is the primary reason that somebody has chosen to exit, but it's certainly one more check in the box of this is becoming difficult. I'm not sure, that the consumer is, really is going in all in on EV, and we've got to spend all this money for infrastructure. My inventory, I may have a bunch of inventory that's not selling. You can see the EV days on hand is 100+ days. Versus ICE engines. So yes, it's definitely becoming more impactful. So let's talk multiples real quick. So we publish this, we get this information from a variety of sources, transactions we're working on as a firm, talking to our friends in the industry, CPAs, attorneys, other buyers, what they're seeing in the marketplace. And so these represent the average multiple for a store. Now, there are a lot of factors that move a multiple up or down. Some would be, whether is the store an overperforming store or an underperforming store? Are the facilities up to current image requirements? Is it in a growth market, or is it in a more challenging market from a population, taxation, regulation perspective? Does that franchise sell products that are in demand by consumers in that market? For example, if you're a domestic Chevy, Stellantis, Ford, and you're in Texas, it's a big truck market, and that's what these guys sell. So you're much better off than if you're a Ford dealer, say in inner city New York, New Jersey, Philadelphia, somewhere like that, where consumers are looking for fuel efficient small cars, things of that nature. So there are a number of factors that move these multiples. But in general, you can see where the trend is, and it kind of buckets itself into the luxury up on the upper left. There are fewer luxury brands. Their performance is much more consistent, so there's less beta risk, so to speak, with those brands. And so buyers are willing to take a lower return on investment because they know they've got strong, consistent earnings, strong demand, and less competition for that like model. Then you kind of get into the Toyota, Honda of the world, and you can see we've actually continued to increase Toyota in our multiple range, because we've sold a lot of Toyota stores over the last 24 months, and every one of them has been it's almost like a feeding frenzy for Toyota. People really, they love the OEM, they love the products that they generate, they love strategically where Toyota is going and how they're addressing the EV phenomenon. So we recently raised Toyota again. Then you kind of get down into the domestics. We recently lowered Stellantis for a couple of years there. They were doing really, really well, but it seems like their production has not matched up with demand, not only from a sheer volume standpoint, but from a content standpoint. Most Stellantis dealers we talk to, they've been loaded up with high content, high ticket cars, trucks, SUVs, etc. While most of their consumer demand is more for the mid-tier and lower tier volume models. So Stellantis has got a heavy inventory, and they're definitely seeing earnings come down more so. Mazda's one we highlighted here on the right that we recently bumped up a little bit. They continue to they're not at the level yet of a Toyota, Honda, Subaru type scenario. But in the past, a lot of times when we would have a group of stores and Mazda was part of it, you'd get that question, well, do we really have to buy the Mazda store? And now it's not an issue as far as including Mazda, and in many cases, buyers are pleased to have Mazda. Their products are much more desirable. They've gone upstream They've imaged about, I believe, well over 90% of their volume is through the new image stores. So the brand's being represented well. Any questions, either from the audience or Paul or Ken on multiples here?
I like this chart. I think it's pretty accurate actually in all across the board. And you guys do a really great job of putting this together. This is really good. Actually, I think your insight on Stellantis was right on point. So if I'd say in the past, of course, with Jeep Dodge brand has just been really strong, especially in the Jeep territory for a lot of our clients. And it's definitely, you've seen it falling off in terms of production and quality as well. So I think they've definitely suffered some issues. And we see the same thing with Mazda as well. So we were at clients yesterday, has a Mazda dealership, and they're getting unsolicited offers every day, which is that's pretty rare for us too. I've never expected to hear that, but they're getting it too. So I think your insight on this was right, spot on.
Great. Excellent. So how does this all boil forward? So this is just a simple math. This is not weighted average or anything. This is just kind of simple average multiple time, the average multiple of all those multiples times the average earnings. What's the average blue sky on a store? And you can see it's off about 12%, still significantly at 22 million, well over the historical norms, over double the value. And you're like, well, wait a minute, that doesn't quite match up with the decline in earnings. I think one thing you need to keep in mind is as buyers have been transacting over the last 12, 24 months, they've anticipated the earnings coming back down a little bit. So they've already begun to factor that in to their valuations. So some of that decline that we're seeing now was already realized in values before. So it's not an exact dollar for dollar decline in the average blue sky. Some of this is also a factor of, and it's probably we would need a whole nother webinar on this. It's really a multiple of what earnings periods. That's a lot of the question. So you're seeing buyers take a lot of different viewpoints on what earnings years they're going to use. Are they using a blend, an average, a discount, et cetera? So we do a lot of math on that, a lot of reverse engineering on that as we're working with our clients on the valuation expectations when they're selling their dealerships. But in general, using the methodology that we're familiar with based on our internal analysis times the multiple, you're seeing this as a result. We've got about 5 or 6 minutes. I want to go real quick and just a couple slides on EV because Paul and Ken have some slides they want to talk about it as well. This is not meant to be political at all. It's really just to give you some additional information. I suspect everybody on the webinar is already painfully aware of this, but in case this gives you any additional talking points as you're visiting with your OEM or whatnot. Just obviously the whole EV push pull, is it demand? Is it being pushed down from the government? What is it? It's become quite a challenge. As many of you probably know, a lot of this is being driven by the increasing government requirements around emission standards with the CAFE standards. And now you have these CARB states, CARB stands for California Air Resource Board, who have taken the CAFE standards and then supplemented them, increased them even more. So it's requiring OEMs and then obviously the subsequent the dealer to be even more into the EV world much more quickly. As you can see here in the CARB states, they've got to be 100% EV by 2035. So you've got a lot of factors going on in here that are impacting the dealers. And forgive me, I'm going to go quickly here. Obviously, infrastructure, we read about this, we see this. If you've got customers who've been buying EVs, you're probably hearing some horror stories around. They've committed to the concept. They've been an early adopter to EVs, but the charging network is still insufficient by a large stretch. You can see we need, a 2,000% increase in chargers, but also the chargers that are in place, 1 out of 5 of them isn't working anyway. So we've got an infrastructure issue that, it's got to be addressed. Dealers, as we talk to dealers, some of the reasons that they're frustrated around EVs, back to Paul's question earlier, you've got big facility improvement requirements. My partner Alan shared a interesting story of a Ford dealer who was, needing to build the new charging stations based on the Ford requirement, but the local power utility could not get him the power for a long time that he needed. So what he ended up doing was building the charging stations, built a concrete block wall, and then hidden behind the wall are gas powered generators to power the chargers. So sometimes it's a real head scratcher on what OEMs are requiring versus what the dealers can actually accomplish. You've got crazy.
We had a client in Texas where they asked the city council to look at putting the power into their area, and they said it would be at least 5 years before they could consider it, and maybe another 5 years before they would build it.
Yep.
And the manufacturer said, "Well, why don't you build your own power plant?" It's like, okay.
Oh, I wish you could. You should be able to record some of these conversations and play it back sometime and say, "Does this make any sense at all to you guys?"
Unbelievable.
Oh my gosh. Obviously, the incentive programs with the Inflation Reduction Act, things like that, have really become more complicated. The whole consumer demand item, and we'll talk about that on the subsequent slide here, is really a bit of a mismatch. We had a lot of early adopters who had spiked the initial demand for EVs, but now it feels like it's settling down to more of a gradual adoption of EVs, less of a upward roller coaster trend to it. And then there's a question of fixed ops. I don't know that we necessarily subscribe to this. There are a lot of people that are concerned about what this is going to do to fixed ops, but it feels like a lot of it is just transitioning from certain repair requirements to others, because tires are wearing out, brakes are wearing out much faster. The cars are much heavier, so tires go. I read something somewhere where somebody was expecting 40,000 miles on their tires and they had to replace them in like 13,000 miles. So, and then they're very complicated vehicles. They break. Very few cars these days go in for a full engine or transmission rework. It's usually something technical or fit and finish, and that probably will continue with the EVs. So hopefully, we're going to continue to see that as a very much of a strong profit producer for dealers. What are some of the big issues that consumers keep raising around EVs? You can see on the chart there, price, number one for sure, just a 16% premium to buy an equal EV. Even with the tax credit, and a lot of people can't qualify for the tax credit. So, that's an issue. The range anxiety with the charging, that's ongoing for a while. The limited charging options, towing. Fire risk is interesting. I had a call from a dealer a couple months ago. He's like, "Did you hear what happened in one of my stores?" And I'm like, "No." He has a Mercedes dealership as one of his dealerships, and one of his service customers took a Mercedes EV home as a loaner car, parked it in her garage, didn't drive it. The next day, the EV caught fire in the garage and burned the whole house down. So, if you're familiar with the EVs at all, it's a real issue when they catch fire. It takes hours and hours to put out. So you've got the whole fire risk. I think most dealers are now facing the fact that somewhere on their site, they're going to have to build dedicated storage for the batteries, maybe segregate their EV inventory from a fire risk, not leave your EVs in the service department overnight, things of that nature. So you've got that problem. You've got the weather as it relates to charging. In cold weather markets, the battery life comes down significantly. Conversely, in hot markets like Florida, where we are right now, the converse happens. So in the summer, you're not going to, when you need AC all the time, it's going to really degrade the battery. The tax incentives, and then the whole trade-in value. I mean, what's my car going to be worth? What's my real true cost of ownership? Because I don't know, as the battery comes down, it's not like replacing your battery in your conventional car, which it's, $150. Now you're talking thousands, if not tens of thousands of dollars for an EV. So at some point you trade the car in, is the car effectively worthless because the replacement life on the battery is more than the car is worth. So a lot of issues there, and I apologize, I'm going really quickly. The domestics and the foreign OEMs have pulled back. These have been, fairly noteworthy over the last 30 days, based on the fact that the consumer demand has dialed back. You can see all the domestics. Ford and GM have announced reductions in their EV spending and their production. Toyota, who's been we feel the most progressive in their view around plug-in hybrid, supplementing EVs, etc., they're pulling down their forecast. So It's going to be an interesting next 12 months. And I haven't even talked about the election and how that may or may not impact the whole EV thing, because obviously both parties have different perspectives
One
on
question
that.
I have for you too, Kevin, sorry to interrupt, was
Yeah.
Tesla's pricing scheme, where they just keep lowering the price and lowering the price. And what do you think the long-term impact of that might be?
Well, it's obviously pressuring the OEM. I mean, they're already losing billions of dollars now. And if, Tesla's kind of saying, okay, well, let's increase the pain here because we're going to lower our price point to a level that maybe the OEMs can't, feasibly produce. Who knows what the UAW contract, what their ultimate costs are going to be. So you're right, Ken. It's a crazy time right now trying to figure out how this is all going to work out. So back to Paul's point, it's becoming more and more of an issue for dealers on the sell side about, I don't know what's going to happen with EVs. Should I get out while the getting's good? And then how would you like to be a Tesla customer that bought a car and then the next day you pick up the paper and your car's worth $5,000 less because they dropped prices?
Yeah.
So, well, that's what you get for you buy a Tesla, not if you're not buying through a dealer. So,
Exactly.
all right, real quickly, just as it relates to what goes into an EV vehicle, I thought these next couple slides were just very interesting. So the top bar just shows the amount of overall minerals, raw materials that goes into an electric vehicle versus a conventional car. So you can see the magnitude and the quantity of the various minerals there. And then this next slide represents where are these materials generated, who has control of these materials. And so the blue, little blue bar, that's the United States. And if you don't have your glasses on, you probably need to put it on because it's really hard to see much blue on that chart. And the red is China. So in many regards, we, maybe shifting our reliance from the Middle East on oil to China from a minerals perspective. So I'm sure you've heard a lot about that in the political environment as well. And again, I'm not taking a side, just kind of sharing some information as it relates to as we migrate, what issues we might need to.
This is a compelling slide, Kevin. Really compelling. Yeah.
Compelling or scary, depends on your
Oh,
perspective.
all the
Yeah.
above.
Yeah. So, Paul, you've got a few slides. Let me shut up and let you jump in.
All right, and I'll be real quick here. A lot of these points that I'm going to cover here, we've touched upon from an industry perspective. I wanted to just have a couple slides here to talk about, dialing that back to the individual dealership level or the group of dealership levels and talking about values and, what goes into or what comprises the value of a dealership. And when you think about it, value is a forward-looking concept, and that would apply to anything. Anything you go out to buy, whether that's a new car, whether it's a set of golf clubs or whatever, you're looking at what benefit is going to provide you in the future. And there are three factors for any business that drive what that value determination is, and that's the growth expectation, the profitability expectation, and the risk. And it would be the risk in that growth or the risk of that profitability or outside risks, any kind of risks. So every dealership is dealing with these three factors. When you're looking at growth, Kevin touched on a lot of points where it's hard to tell where growth is going to go, what growth is going to be, and it's individual to your own dealership or your collection or group of dealerships. And there are a lot of factors that go into that geographically, the brand you have, whatever. So you can't just put one benchmark number on something and say that's what our expectations of growth are going to be. Everything is individualized. Profitability, Kevin touched on profitability's coming down. We're seeing that. They're coming down, but they're still higher than what they were, in the pre-COVID era. So let's see. And then risk, everything that Kevin touched on, talking about the industry as a risk to an individual dealership. And then you have your own risks to deal with. So can you go to the next slide then? I guess that brings us around to the benchmarks, all these benchmarks you hear, multiples of earnings, the blue sky multiples and things like that. Those are just that. They are benchmarks for every for every benchmark, there are dealerships that are above the benchmark, dealerships that are below the benchmark, and the value of your individual dealership is based on all those factors that apply to your dealership that may not necessarily, you may not be right in the middle of the benchmark numbers. So take those with a grain of salt. Some of those factors you can control, some you can't. Just the idea would be to focus on the things you can control in the short term, and deal with the things you can't control as best you can. That's all I have.
Great. Ken, you want to wrap it up?
Oh, yes, I do want to jump in here. We missed a question from Rich, so if we can just answer that real quick. It's what % of transactions fall within the average? How much have you seen outliers? I think we may need to go back some slides.
Yeah, I think he's probably referencing the multiples slide as it relates to what percentage are in or out of the range. I would say that most deals are in the range. Again, there are some specific situations that will drive something outside the range. For example, like the opportunity I shared with you with Toyota, we were seeing Toyota deals trade above our range. So that prompted us to move the range up. People were very much desiring that Toyota store. A lot of these stores were trading in great markets. So, we push that multiple up. You'll see, there's some big factors like Florida's example. Let's use Florida and Texas. In general, if you took these multiples, but it's a store in Florida or Texas, you can pretty much add at least one multiple turn to it just because of the demand for stores in those two markets. High growth, very business friendly, low taxation, plenty of real estate to build your facilities, things of that nature. So there are instances where specific scenarios dictate that the multiple tends to be higher. But in general, I would say, most trade in the range. And that's why we have a range here, because there's no exact science to say every Toyota store trades at 7.5. So there's pluses and minuses for those.
Yeah, just keep in mind that the value of your dealership, or the value of all the dealerships that go into creating these multiples, those values create the multiple. The multiple doesn't create the value. So we tend to look at dealerships and calculate from all the factors that we consider. We calculate the value, what we think the dealership is worth, and then we look at the multiple that's implied from that calculation of value to see if where that fits within the range, and see if that's reasonable. So we kind of look at it from a different perspective, or the other direction.
Yeah. And, there's, I think from what we do versus what, Paul, you're doing in general, we're a little bit different. We're coming at it from a market sale perspective. You're coming at it in many cases from, minority shareholder repurchases or divorces or, tax issues, estate planning, things of that nature. So sometimes it's also a little bit of a different requirement from how you derive the value.
That's
Correct,
right,
Kevin. That's a good point, Kevin, too. Sometimes also retiring shareholders, like minority shareholders that might be retiring or something like that. So it's a different concept for sure. Absolutely. Well, thank you guys very much, Kevin. It's always a pleasure.
Thank you for having me.
And working with you. And thank you, Paul. Paul's worked on hundreds of dealership valuations in the last couple of years, and he's seen more than his fair share, that's for sure. Thank you all for attending. Really appreciate it.
Everyone have a Merry Christmas. Thank you.
Thank you.
One more question.
Sal, on these multiples, does it include land?
Well, I'm sorry, I couldn't hear you.
On these multiples, do they include land?
No, this is just the value on the intangible asset. In most cases, it's the franchise, the naming rights, things of that nature. When you sell a dealership, it's an asset sale. It includes the franchise value, which this helps generate. It includes the real estate. Typically, that's off balance sheet. It's another entity. It includes the assets on the balance sheet like vehicle inventory, parts, et cetera, things like that.
Thank you. And I
All
do
right,
want to
everyone.
let everyone know that we will be publishing the recording of this webinar. Thank you all for your time today.
Thanks for coming.
Thank you.
Thank you.